Advanced Financial Accounting. In this presentation, we're going to work a consolidation problem for year zero. This time, however, not with a wholly owned subsidiary, but only a 90%. So there is a controlling interest. We're going to have a parent-subsidiary relationship, but the parent owns not 100%, but a controlling interest over 51, but not at a full 100%, 90% in this case, of the outstanding shares of S. Some of the other conditions we're going to have is that right after the consolidation, meaning year zero, is the point in time that we're going to consolidate. So we're going to say, hey, the consolidation happened basically right at the same point in time that we're going to then do the purchase. The purchase happened at the same point in time as the consolidation. Next time then we'll take a look at a year out where 1 year has passed. This time again, we're just looking at that current point right after the consolidation took place. Also note that we're going to be saying that the consolidation or the purchase of the 90% happened to be for exactly 90% of the net assets of the subsidiary at the point of purchase. That's going to be another one of the conditions that we will have, and we're going to be varying and changing more of these conditions as we move forward. The major change here, of course, being the 90% ownership rather than 100%. Get ready to account with Advanced Financial Accounting. Here we have our data on the left. We say P is purchasing 90% or purchased 90% of the outstanding stock of S. So P is going to be the parent. S will be the subsidiary on 11X0 for the 344,700. So we're going to have our information over here then. This is going to be P and S. This is going to be the start of our consolidation worksheet, which we will add together, of course. Note, however, that we're talking about this as of the point right after consolidation. So we're not talking about a year later. We're saying, hey, the consolidation just took place and or the purchase just took place and we're going to do the consolidation right after the purchase. And then we'll do another presentation later thinking about a situation where we have 1 year out, 1 year of data since the consolidation. So the purchase just took place. So let's just consider company S over here. We're going to say, all right, if we take a look at company S's data, then that means at the point in time that this purchase transaction took place, we had the 34,000 plus the 44,000 plus the 80,000 plus the 105,000 plus the 207,000 minus the 6,000 minus the 25,000 minus the 56,000. That equals the 383. So that's going to be the 383. That's the book value, or in other words, then that's the 182,000 of equity plus the 201,000, the 383. There's no income statement information, revenue and expenses, because it's right after the consolidation. All the temporary accounts are currently closed in to equity. Now we paid 90%, and when I say we, I'm considering ourselves as the purchaser, times 90% times 0.9, that's going to be the 344.7. So in other words, we still have that kind of condition that we have met. Even though we don't have 100%, we are purchasing our portion of 90% of the net assets was basically the purchase price. So that's going to be one of the conditions. That's not typically always the case, in practice. So we're going to be deviating from that in future presentations, but we want to keep that stipulation here, so recognize that. Then we're going to say P uses the equity method to account for the investment in S. So when we're thinking over here in terms of this investment in S, how did we get to that? We're going to use the equity method. That's what you would typically think would be used when you put it on the books. Now here, it doesn't really matter what method they use because there hasn't been any activity since the point of purchase, and we purchased it for the purchasing amount, and then we would use the same under the equity or cost method. So there's that, and then we have make consolidated balance sheet at acquisition date, and that's what we'll end up doing. So if we do that same calculation, remember we have the book value for the purchase. This is the book value of S, which we just saw was the assets minus the liabilities, or just the equity section down here. Same thing, of course. And then we have the interest purchased by P, 90%. That means that the book value of P interest is the 344.7, and the amount that was paid was the 344.7, right? So there's no goodwill, in other words, that we're considering with regards to this consolidation, because the amount that was purchased equals basically the book value of S at that point. So the book value of at purchase S, 383, and then the non-controlling interest then is 10%, and that gives us then the 38,300. So in other words, the 38,300 here plus the 344,700 is going to give us the full book value of the 383. So we have to deal with this non-controlling interest. That's kind of the new thing. In other words, S is completely owned, not completely owned by P, but controlled by P, given the over 51% or 90% interest. So we're going to do the same thing. We're going to consult. The first thing we're going to do is consolidate this across. And you might say, so we got P's books, we got S's trial balance, P's trial balance, S trial balance. We have to, line them up just as we've seen in the past, which isn't as easy as you would think, but it's not hard. It's just kind of more tedious than this, obviously, because the accounts wouldn't line up perfectly. We'd have to line them up. Then we would add them across. So we're gonna add them across. There we go. Now you might be saying, why would I do it this way? I should be taking 90% of everything in column S, right? Because really you have a 90% interest. But that's not how we're going to do it here. We're going to do the full consolidation, and part of that would be because, P has a controlling interest over S. So we want to show the full consolidation, in essence, of the assets and liabilities that P has control over. And then we're also going to show the non-controlling interest. However, we will do so with basically another account down below. So we're going to do the same consolidation kind of process here, then go through our elimination entries. However, now, along with the elimination entries, we're going to basically be adding this account non-controlling interest for S here. So we're going to be including that in the net assets, non-controlling interest in the net assets for S. Now, when we add the income statement, we're going to break out that non-controlling interest, and we're going to have another kind of account on the income statement. So this will be a bit more simplified. That's why we're doing it right after the purchase took place. And then we'll do it a year later and the next one. So same kind of process. We're going to say, all right, at least I know this has to go away. The investment has to go away. So let's do that. We're going to say the investment's on the books for the 344. We're going to credit it, making it go away. So here it is. Then we're going to credit it, making it go away. So, all right, we know that. We know that the other side is going to be in the equity section. Now, this is the confusing part, because you would think, hey, look, we only purchased, this represents, because we purchased it for 90% of the book value, this represents basically 90% of equity, because we're at the same point in time. So you would think you'd have to take 90% because, you can't take the whole common stock off, you would think, because 10% is going to someone other than P. Only 90% of the stock is going to P. 10% is going elsewhere. But we're going to be removing the entire thing. We're going to do the full consolidation and then represent that portion, the non-controlling interest, in one account. So this part is actually easier that way, because you can say, all right, even though I only have a 90% interest, I'm going to remove all of the equity, basically. So same process as if it was 100%. We got the 482 plus the 182 is the 644 minus the 182 brings us back to the parent portion of the 482. We're going to do the same for the retained earnings. You're going to say, hey, but we don't have claim to all of the retained earnings. We only have claim to 90% of them. But we're going to remove the entire thing and then represent the non-controlling interest, the 10% portion, in another account. So we'll remove the whole thing once again. So we're going to debit it. So we've got the 4097, the 201 gives us the 6107, minus the 201 brings us back to the 4097 piece portion. All right, and then we're going to have that non-controlling interest, which basically just works itself out in this problem, because note, we purchased this thing for the investment, which was exactly 90% of the interest. We have no goodwill or thing that's gonna mess up our calculation, because this happened to be exactly 90% of the book value. And then this was the equity section at the point in time of purchase. So the difference then is the 38,000, which represents the 10%. So in other words, we know that the equity section, assets minus liabilities, equals the equity. The equity is the 182,000, the 182,000 plus the 201,000, and you'll recall that 90% of that is going to be the 344. So there's the 344 that was represented up here that we are removing. And then we have the 182,000 plus the 201,000 times 10%, the non-controlling interest, and that of course is the 38.3. So now we can represent that 38.3 just as one line item in the equity section. So now we're going to post that, and there's the one line item in the equity section here. So basically we said, hey, look, we're going to combine the whole thing together. We're going to eliminate the investment in S, just like we normally would. And then we're going to show this whole thing as if they're combined together. We're not going to show like 90% of each account. We're going to eliminate the entire equity section as we would basically if there was 100% interest. And then we're just going to show the full non-controlling interest basically as one line item in the equity section here, that 38,300. Then we're going to do the same thing with the depreciation we've seen in the past. So we're going to remove the accumulated depreciation at that point. So it's currently at the 6,000 for S. We're going to remove it and basically consolidate the book value at the point in time of consolidation. And remember, this happened right after consolidation. Right after the purchase. So the purchase took place, consolidation at the same point. So that brings us back to just the parent amount for the accumulated depreciation. Then we're going to remove the book information or decrease the book value by that amount as well. So here's the book value, and so we're removing that just as we've seen in the past, basically putting these two accounts at the point of time that the purchase took place, putting that onto one line item at the 201 rather than having the two lines. So that's going to be the same process we've seen in the past. Now that we have our information over here, let's go ahead and just put this into a quick balance sheet just to get an idea of what this would look like in the balance sheet. Now, I'm not going to get into a lot of detail on the formatting. I just want to put this into the balance sheet so we can represent kind of this new account that we would have down there and consider it. So most of the balance sheet would be the same, right? We're going to have the assets. We're going to say the cash. I'm just pulling over these numbers. Notice we're pulling over the full amount. We're not taking 90%. We're pulling over the full amount here of all the assets. I'm just pulling up into like a simplified version of the balance sheet. I'm not breaking out the categories, in other words. So that's going to get a one-step balance sheet kind of. And so that gives us our total assets of the $1,249,000. Then we're going to have our liabilities at the 81 and the 238. So notice again, we're not taking 90% of those. We're taking the whole thing. And that gives us the 319. Then if we look at the equity section, this is where we have something new. We're taking the common stock, which is basically the P's common stock, because those are owned by people outside the organization. S has 10% of their stock owned by people outside the organization. But again, we're not showing, all of that has been removed, the whole common stock, because we're going to show the 10% equity portion in another account, right? And so then we have the retained earnings. Once again, for basically the P's retained earnings here, S's has been removed. Then we're going to show that 10% interest that's showing in just one line item. We're saying, hey, look, this of the assets minus the liabilities up above, these assets minus liabilities, this is the portion, the 38,300, that we in this consolidation, in essence, P, because basically this whole consolidated financial statement is for people who are interested in P, right? The stockholders of P and the creditors of P are usually going to be interested in this, right? So we're going to say, yeah, P has control over these assets and liabilities through the controlling interest. However, they don't have claim to the 38.3 of those assets and liabilities. So in other words, upon liquidation, the 38,300, that's one way to think of it, would be going to people other than the shareholders of P. They'd be going to the 10% shareholders, of S have basically claim to that portion. So you can see what's happening here. We're going to say if you're a holder of P, a stockholder or an investor, you're looking at the long-term interest of P. You could say, okay, P has control over assets and liabilities here, and that represents the equity interest. So here's the full equity interest, and then here's the non-controlling interest, the 38,300, which represents part of the net assets above, part of the assets minus the liabilities, for which P has control over, but doesn't have claim to. And that's how you might want to, that's how you can kind of consider this. So that gives us the total equity. And then, of course, the total liabilities and equity down here matching up to the total assets. So the new thing is going to be this item.